Hi, everybody. Professor Henry here. Just wanted to do a quick video about some of the material in Chapter 13. Um, Provide a little bit of background information, make things maybe make a little bit more sense than you get just from reading the textbook. Apologize in advance if this video gets a little bit long, but it's shorter than a class period in any case. The whole chapter is about risk, and in particular, the effect of investment risk on rates of return. You can see the definition here that, in quotes, risk is the chance that some unfavorable event will occur. What that means in our context really is that an investment's actual realized rate of return will turn out to be less than what we expected it to be. Almost all investments in financial assets have some sort of risk involved, and it's probably not a surprise to you to realize that the riskier an investment is, the less desirable it is. If something is less desirable, it means that, well, it's worth less. The riskier something is, all else equal, the less you're willing to pay for it. And if you think back to the bond chapter, for example, we saw that the rates of return required and the prices of bonds were inversely related. We saw that when the yield goes up, the price goes down. And that's true of all investments. So what we're seeing here is that if an investment becomes riskier, keeping everything else the same, it becomes less desirable, its value in the marketplace goes down, which corresponds to, it's equivalent to saying that the rate of return that investors require from it is going up. There's a quote from the textbook on this slide. I always like this. Very succinct. It says, "No investment will be undertaken unless the expected rate of return is high enough to compensate the investor for the perceived risk of the investment." And that should kind of follow from the logic in the previous slide. People will only invest in projects or invest in securities if they can expect enough of a rate of return to entice them, to compensate them for the risk that they take on. Another way of saying that very thing is to say that investors, when they choose an investment, they expect to earn what we call a risk premium, some amount of additional return in exchange for accepting risk. If we're going to talk about the relationship between rates of return and investment risk, we probably need to be able to measure investment risk in some way. And if you read through the chapter, I don't rely on this too much, but I'll mention it here. If you read through the chapter, you'll notice that risk is often measured in terms of, well, statistical properties, like the standard deviation. And it's possible to measure the risk of an investment by calculating, observing the rate of return that it generates over some period of time. Say for the last 5 years, we calculate the monthly rate of return on a particular stock, and then over that same 5 years, calculate the standard deviation of returns. This is a quantity. The result of this would be called volatility, in this case, monthly volatility. And that has its uses. It's a measure of an investment's total risk, but as we'll see a few slides down the road here, it's not a complete picture. It doesn't tell us everything we need to know about risk. Just graphically, you can visualize risk. This is a chart showing the rates of return on two different stocks, two different company stocks. The blue line is Coca-Cola, the red line is Citigroup. And I don't have the standard deviations calculated here, but I think if you just glance at these, you would realize that over the 5-year period pictured, well, one stock is a lot more variable than the other. One stock is more volatile. I would say that it's pretty clear the red line, which corresponds to Citigroup, during that 5-year period was a lot more variable than Coca-Cola stock was. The returns were changing more. Definitely in terms of total risk, during that period, Citigroup was the riskier of these two stocks. This gives us an opportunity to look at a really important concept when it comes to talking about investment risk, because this concept drives our understanding of how investors are compensated for risk. It's this idea of diversification. The first bullet point on the slide says, as long as two investments are less than perfectly positively correlated, a combination of the two, which is something we call a portfolio, will have less volatility than the average level of the volatilities of the two, and potentially less volatility than either investment by itself. What that means in the context of these two stocks is that if we were to create a portfolio of Coca-Cola and Citigroup stock, the combination of the two would have somewhat less volatility, potentially less volatility than either stock by itself, less risk. That happens because there are periods during which Coca-Cola goes up and Citigroup goes down. I'm looking at the moment from October to December of 2009. The third column in this chart, you can see the blue line going up, the red line going down. During some periods, the poor performance of one stock is offset by the better performance of the other. And on average, things kind of smooth out. It's a pretty easy way to minimize the risk that you face. Diversification is easy to achieve. You just split your investment dollars between 2, 3, 4, or more different risky investments. And by doing so, you can significantly reduce the amount of overall risk. Here's the same two stocks on a chart, same chart actually, with a third line added. What the third line, the green line in the middle, represents is the S&P 500 stock index, Standard & Poor's 500. Basically, it amounts to an average of the returns of 500 large company stocks, mostly in the U.S. It includes both Coca-Cola and Citigroup. So that green line represents the average returns of a portfolio, the returns on a portfolio consisting of Coca-Cola, Citigroup, and 498 other stocks. This is certainly a well diversified portfolio. We would typically say that if you have more than about 30 stocks in a portfolio, it's very well diversified. And having 500 stocks in a portfolio is extremely well diversified. The thing to notice here is that even though we have extensively, the S&P 500 index, this green line, represents an extensively diversified portfolio. It's not a straight line. Returns didn't follow a perfectly smooth path over that 5-year period. There was still plenty of variability, still plenty of risk. What I said on the previous slide, and the last point, diversification is a really effective way to reduce risk, but it doesn't eliminate risk. Some risk is minimized, but we can't diversify away all the risk of an investment. I said earlier that investors expect to earn additional return to compensate them for bearing investment risk, and we call that a risk premium. But here's the thing. You don't get compensated for bearing risk that you could easily avoid. The marketplace will not let you earn extra returns just for bearing risk that you don't have to. As an analogy, I said here, if the weather forecast today calls for rain, and you know that, and you get wet, nobody will feel sorry for you because you should have brought an umbrella. You knew it was risky. You could have done something about it, but you didn't. Same follows with investment returns. Investments are risky. You can expect to be compensated for bearing risk, but if you can avoid risk by diversifying, it's expected that you do that. And you shouldn't expect to earn extra returns just for taking on unnecessary, avoidable risk. What we saw with the S&P 500 index, backing up a slide here, again, we have two risky stocks, the red and the blue lines, and a very extensively diversified portfolio, the green line in the middle. You can minimize risk by diversification, but you cannot eliminate all of it. And when it comes to pricing securities or understanding how returns and risk are related, the only kind of risk that matters is the risk that's left over after you extensively diversify your portfolio. The risk that you can't just diversify away. That's what you get compensated for. That's the risk that you can expect should earn you a higher rate of return in exchange for bearing it. Sort of a quick recap here of things that we know so far from this chapter. Throughout the course, we've said that one of the main things we do in finance is valuation, to estimate the values of things. We know that if we're going to assess the value of something, we have to know what rate of return is expected. It's one of the inputs to the present value equation. We said earlier here in this slideshow that the expected rate of return on an investment depends on its risk. Investors expect a greater return on riskier investments, or that is to say, investors expect to earn a larger risk premium on riskier investments. And we just said that, as it turns out, when we're valuing an investment, the only kind of risk that matters is the risk that is contributed to the risk of a diversified portfolio, the risk that cannot be diversified away. You can give some names to these things. Some things we already know. When you hold multiple securities together, when you spread your investment dollars across several different risky assets, we call that a portfolio. When you hold multiple securities in a portfolio, risks that are specific to individual companies kind of washes away. Like between Coca-Cola and Citigroup, there were some periods when Coca-Cola was going up and Citigroup was going down. And those firm-specific things kind of cancel each other out. Those firm-specific risks are referred to as non-systematic risks, and those are the things that diversify away. As we saw, though, not all risk diversifies away no matter how much you diversify your investment. We saw that the S&P 500 index, which is a portfolio of 500 large company stocks, still has risk. And that risk that's left over is what we call systematic risk, or sometimes market risk, or non-diversifiable risk even. All those terms mean basically the same thing. The justification for this, for our ability to ignore the firm-specific risk, is basically this. If you're an investor who has a diversified portfolio of stocks, what it means is when you consider adding another stock to your portfolio, the firm-specific elements of risk don't matter too much to you. They kind of wash away. If you have 500 stocks in your portfolio and you're adding number 501, the firm-specific elements of risk are not too important to you. What matters to you is how does that next stock affect the risk of my overall portfolio? Does it increase the overall risk or decrease the overall risk? Holders of diversified portfolios are the investors who perceive the least amount of risk from a potential investment. And if you perceive the least amount of risk, you're willing to pay the highest possible price. So ultimately, the value of a security in the marketplace, which is driven by how much the highest bidder is willing to pay, is going to be determined by how much risk that well-diversified investor perceives. Going a little bit deeper into some of these terms, this firm-specific risk or diversifiable risk, these are risks associated with random events that affect maybe one company or a handful of companies without affecting the market as a whole. Things like strikes at the factory, a product lawsuit, things that may be bad for a particular company, but don't affect the broader economy as a whole. These are the risks that diversify away. They're called diversifiable risks or firm-specific risks. The other component of risk is what we call market risk or systematic risk. And again, it's the risk that cannot be diversified away. Things like interest rates going up. We're living through one right now with the coronavirus epidemic. No matter how many stocks you had in your portfolio 3 weeks ago, if you had money invested in stocks, you probably lost money. There was no way to diversify against the effects of the market crash caused by coronavirus. It's an example of a market risk. You could not have diversified your way out of the consequences of that. These are examples of systematic risks. I'm skipping over some math here. The chapter does too. But it is true that it's possible to measure how much market risk an investment carries, or to measure a particular investment's contribution to the risk of a portfolio. The measurement is called beta. Beta is a measurement of the portion of risk that cannot be diversified away, or what we call market risk or systematic risk. It's also true, I don't want to say it's true. There is a very widely accepted model that predicts that the rate of return on any investment is related to beta in a very simple, predictable way. Remember, our goal for the chapter was to try to understand how the rate of return expected on securities is affected by the risk of those securities, the relationship between risk and return. And what I'm saying here is that there is a very widely accepted model that relates those two things. Using the model, if we know a stock's beta, if we can measure how risky it is in terms of its systematic risk, we can use the model, the formula, to figure out the rate of return that an investor should be able to expect from that investment. A bit more about beta. Beta, you might guess from its name, is a regression coefficient. It's a statistical concept, and we're not going to worry about how it's estimated or the mechanics of that. That's for a different course, but we will talk about how to use it. Again, beta measures a stock's market risk. Beta is just a number. It's, I guess technically it represents the slope of something called the security characteristic line, but you don't need to know that. It's just a number. It represents how risky a stock is relative to the average level of risk. It's centered around 1.0. A beta of 1 indicates a stock that's about as risky as the average stock in the marketplace. By definition, the average beta of all stocks is 1. Betas larger than 1 indicate stocks that are more risky than average. Betas smaller than 1 indicate stocks that are less risky than average. That's about all you need to know. Again, it's just a number. It's not a percentage. It's not in dollars. It's just a number. And typically you'll see betas ranging from somewhere around 0.25 at the low end to maybe 2 at the high end. It's something you can estimate directly if you dig up past history of stock returns and do some statistical calculations. Again, it's a regression coefficient. If that means something to you, that's great. That might explain a little bit of it. But more practically, it's something we can look up. The estimates of beta are widely published on websites by brokerage houses and the like. You can see one here on the screen for Bank of America. Beta is estimated to be about 1.63. At the current time, Bank of America's risk is considered somewhat higher than the average risk in the marketplace. That's a pretty high beta. Okay, how do we use this? Well, we said that the expected rate of return on an investment should depend on its risk. We've said that the kind of risk that matters is this market risk or systematic risk. That's the only kind that you can expect to be compensated for bearing. There is a model, a formula, that expresses the relationship between these things, between risk and the rate of return. It's called the capital asset pricing model, CAPM or CAPM for short. It's a formula. It's not a difficult formula. It's just got 1, 2, 3, 4 variables in it. Pretty easy calculation. There's nothing here but addition, subtraction, multiplication, not even any exponents in it. An easy formula to calculate, really. You can see the expression on the screen here. By definition, I'm going to go through the definitions first. By definition, the risk premium on an investment is the amount of extra return above and beyond the risk-free rate of interest that holders of a risky investment expect. I said that in the overview for Chapter 13. I'll mention it again here. We can think of investment returns as having two components, the pure time value of money, compensation for delaying consumptions, the risk-free rate of interest. All investments, no matter how risky they are or are not, have to earn at least, at a minimum, the the risk-free rate of interest. Risky investments, though, have to earn more to compensate the investor for the risk. The difference is what we call the risk premium. And in the equation here, that's everything to the right of the plus. The risk premium is what's added to the risk-free rate of interest to get the overall rate of return expected. What the CAPM proposes is that the risk premium, which is, again, everything to the right of the plus in this equation, what the CAPM proposes is that the risk premium on any particular individual risky asset should be proportional to beta. The portion in the yellow box, RM minus RF, the RM portion represents the average rate of return on all securities in the marketplace. We call it the market rate of return, or return on the market portfolio. RF, of course, is the risk-free rate of interest. The difference between the two is what we call the market risk premium. That term in parentheses in the yellow box is called the market risk premium. It's a very specific term. It means always that. It means exactly the quantity inside the parentheses. It never means anything else. Inside the blue box is beta, of course, and that's the measurement of the particular asset's market risk. When you multiply beta times the market risk premium, you get the risk premium that applies to this particular risky asset, the one that we're thinking about at the moment. When you add that risk premium for this asset to the risk-free rate, you get the overall rate of return that investors are entitled to expect from this investment. It's a pretty tidy formula and not too hard to implement if you know the inputs. Risk-free rate is one input. That's something we can look up. Usually we would say the rate of return on U.S. Treasury bills is the approximation of the risk-free rate of interest. So it's something that's widely available. RM is the average rate of return on risky assets in the economy. Not quite as easy to estimate, but it's something that we can try to put a number on. And any problems that you encounter in this class, we'll have to give that to you. And of course, beta, which is something that can be estimated for real companies. Estimates are widely published, and we will rely on those. I won't ask you to estimate it for any problems in this course, but you certainly will be asked to use it. Simple inputs, pretty simple formula, and we can plug them into calculator and get the results out. I'll save the calculations for another video. This one's getting long enough, but I do expect another video with a couple of example calculations, and of course you have plenty of similar calculations to work through in the Chapter 13 homework. That's a good place to stop. I will stop here and direct you to another video in this series for some practice with a couple of practical questions related to this chapter.